Hello everyone, and once again welcome back to another video. Quick coronavirus update. Unfortunately, this situation is not expected to quiet down anytime soon. In fact, it has created over the last week a lot of chaos all over the world, and the markets have really responded in a negative way. In fact, last week signed the worst financial week in terms of performance ever since the last greatest depression or recession that happened in 2008/2007, so around about 12 years ago, and we know that something similar is about to happen again because the performance is of that sort of levels. And when I mean performance, I obviously mean a negative return that, as you can see from the graph, this is the S&P 500, has gone from a level of $3,300 down to $3,000 roughly in just about a week. However, I'd like to share with you my view on the current situation in terms of people have been assuming that as soon as market goes down, as soon as markets go down as a whole, that the best way to approach this would be to irrationally and panically sell their holdings in order to perhaps not realize even more of a loss just by holding off. However, I'd like to remind everyone that, generally speaking, investment should be approached with a very long-term horizon, and if you're in it to make a quick buck, then unfortunately this is not the right industry for you, because of the fact that whenever we see graphs like this, would you then realize that if someone had told you you've got to hold everything up until here, does it really matter? And you're starting, let's say, just about here or even there, and this, by the way, represents 20 to 30 to 40 years long-term sort of time span. Would it really matter if the market went from here to there, back up there, back down here? Would you in fact consider things like this an opportunity to panic and therefore sell, or would you consider this as an opportunity, especially down the bottom, to purchase even more? And in order to convey this message even more, what better way to portray this than to show you a very quick snapshot of an interview that Warren Buffett, I'm sure all of you would have at least heard of him in the past, gave on the 22nd of February 2018, so just over 2 years. I'd like to show how relevant that interview still is to this day, and how these concepts are actually the real key to success when it comes to investing. Because people assume that as soon as markets go down, then you've got to sell, because obviously there will be further losses if you don't sell as soon as you can. However, then Warren Buffett, what he's about to say, really listen carefully, because if he's managed to become a multi-billionaire through Berkshire Hathaway and all his purchases all over the years, I think in the video he mentions that, I've edited a little bit, but in the full extensive interview, he mentions that he's been investing since the age of 11. I presume he's over 70 now, approaching the 80s. So imagine the amount of experience and knowledge he's managed to gather over almost a century of a lifetime. So let's get into it, and let's talk about the main points afterwards.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I never felt that I knew it, and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now. Anytime stocks go down, as far as I'm concerned, I like it, because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. So the only person that can cause you to get a bad result in stocks is yourself.
Yeah, unfortunately, that's the biggest problem, is trying to fight yourself in some of these situations.
Okay, so I hope you've taken some great value from the interview you've just watched. Warren Buffett is by far one of the greatest investors of all times, so it's really important to take all these key takeaways away and really think about them if we're serious about investing for the long term. Can you spot a pattern in his words? So he often talks about the longevity and the long-term approach. Therefore, time seems to be the greatest and most precious commodity that he refers to. So I've taken here on this page that I've called Warren Buffett's philosophy the biggest most important 5 points that I believe we should take away from that short interview. So first of all, he said, I never know what markets are going to do. I only know what markets are going to do over a long period of time. They're going to go up. And imagine a guy that is a multi-billionaire, he's been investing for the best part of the century, and still he's that humble to admit in public that he has no idea what the markets are going to do in the short term. So that reveals a very important key aspect of investing, which is what I've alluded to earlier, and that would be to be in it for the very long term. Second point, very similar. In 10, 20, 30 years time, I think stocks will be a lot higher than they are now. And then when stocks go down, it's good news. At first glance, that may seem a contradictory statement that Warren Buffett could give, because obviously whenever you invest into something, unless you shorten the stock, you're obviously hoping that the price would go up. So it would be quite counterintuitive to assume that you should be happy, or you would be happy, when the price of the underlying asset goes down. Well, that's because of the fact that whenever price goes down, you're buying at a cheaper price, and therefore with the same amount of capital, you could either purchase more units, or if you wanted to purchase the same units, you would spend less, and therefore you would have more of a disposable income that in turn you could invest in more units, or just simply keep to yourself. Then, the only person that can cause you to get bad results in stocks is yourself. So that reveals another important lesson, and that, trading, but also investing as a whole, is 90% psychology, and 10% is your strategy and your plan and so forth. So you've got to really combat the demons that are within you, and if you're serious about this, try and keep calm and your mental stability in terms of, it's not pleasant to see that your portfolio, and I've been through this, portfolio goes down hundreds of pounds or dollars or euros or whatever, and you're wondering, should I sell now? Should I prevent further losses from taking place? And that's exactly what he's referring to. Manage your expectations, but manage also your emotions. Finally, we're more aggressive buyers when things are going down. I feel much better when they're going down. Finally, to wrap up the whole concept of, don't feel in a panic situation, in a panic instance when weeks like this take place, but actually be glad that they take place. Finally, I'd like to cover a couple of articles that really show with numerical values the importance of the concept of timing the market is much better than timing the market. So a research carried out by JP Morgan showed that on a theoretical £10,000 initial investment, if you miss the 10 best days of trading over that 20 years period, your annualized performance would go from a 5.62% down to a mere 2%. So more than a 3% drop only if you missed just 10 days in 20 years. Then that keeps on obviously showing the 20, 30, even 60 years. If you really think about this, would it really make sense to put your money out as soon as the market goes down? Are you actually doing yourself a service or a disservice? Think about this. And then finally, miss the worst days, miss the best days. In the previous article we just had a look at, the article was covering if you'd missed the best days. And obviously here we're talking about the coronavirus causing some of the worst days in history, or since the 2007 and 8 at least. So this article actually shows that, where was it? Here. Exactly. So the best days often follow the worst days, and the worst days occur in periods of above average volatility. So although the previous article was talking about the best days, obviously we're now in a situation where the worst days are taking place, and what can we expect? The best days to happen. That's usually because when, and I believe I've covered this in the past in previous videos, when investors irrationally sell, obviously that drives price down and down and down. And at that point, people then spot further opportunities, at least the good investors that are in here for the long term, and therefore they will purchase more of the same units or the market as a whole, and therefore that drives price back up. Finally, here the VIX, which is the volatility index, shows that, let me show you this in TradingView, that whenever the best opportunities take place, they also happen to coincide with the highest levels of volatility. And where are we now? At a very key area. We're here in an area that we hadn't reached in years. I'm talking 2011 and so forth, but obviously I'm not comparing the situation, and I'm not implying in any way, shape or form that we are to be experiencing a similar thing or environment that we saw in 2008, but you're slowly trying to catch the tops and the bottoms, and if you were to do that, you would get hurt. So stick with it with the long term. Don't check your portfolio every day, because that will then play with your emotions and your psychology. Sit with it with the long term, and your 60-year-old, 70, 80-year-old self will thank yourself for the approach you've taken. Thank you very much for watching. I hope you've taken some great value, and until the next one, cheers.